Detection of problem loans red flag. First is operation of the account, income statement. Sales decline. Income statement may influence the trend of sales among customers. Flexibility of this aspect in sales terms can be declined since expenses of the company spend influencing it at early and intermediate stage. Sale increase and profit reduce. For some companies, increase of sales can reduce the profit as the expenses used for manufacturing the product may be expensive in terms of quality branding or quality terms. Next is balance sheet. Substantial increase in debt. Most of the companies are not recognized in this country, so most of them will be having materiality in lending their funds to others. Next is persistent delay in interest servicing. Every lendee will receive interest and principal from lender. This will affect to the lender as the lendee will delay the payment to the lender. This is because the lendee has been received the interest that have been set term loan from lender. Next is business operation. Changes of customers and suppliers. The changes of customers and suppliers will affect the sales and purchases of the company because the supplier and customers will lose their trust to the company. Poor financial records and operation control. Every company must have financial record after they have made any transaction during business hour. Poor financial record will affect company taxation. Thus, the company unexpectedly will pay more than they should have paid. This will lead company financial will having problem and the company operation control will be stuck in long term. Lastly is threats in changing environment. Change in acceptance of public. In this country, most of people will be having threatened changes due to identity of the franchise being manipulated into a new trend and image that can cause people perception to be influenced as new image may not provide the same services as the previous franchise. Changes in government policy and regulation. Shifting of power in government power can influence the market trend as rules and policies may be altered to suit the current economic situation. For example, as we can see, the minimal absence of COVID-19 caused few products to have an increase in price due to manufacturing expenses and workers' high salary demand to suit the norms of economic downfall. This caused few government to make few changes in product price policy to assert profit to every party to sustain everybody in this tough time and lending money will be limited to every of the company.
Now I'm going to talk about the recovery methodology. Recovery methodology is a method to help borrower to pay back the debt. If the borrower did not face a severe difficulty and still have a hope to pay back the debt, the lender should have a discussion or negotiate with borrower in paying back their debt. The negotiate can be done after the lender has identified the borrower has a competence in management, viable core business, and sufficient resource to allow turnaround. However, if the borrower have a bad management, suspicion of fraud, deterioration in value of collateral, and non-viability of core business, the lender should do a legal proceedings such as bring this case to the court. There are 5 different stages that we can follow to recover back the loan. At the first stage is a cooperative workout agreement. On this stage, lender can make a new repayment arrangement that are fit with the borrower situation in making a payment. For the next, lender also may modify the term of loans by lengthening duration of agreement so the borrower have a time to make a payment. Moreover, lender can also restructure the loan amortization schedule to include the deferred principal plus interest due. In short, the lender can postpone the interest payment until a certain period of time. After that, lender can request the additional collateral or guarantors as a security to the lender to get their money back. Finally, lender can force borrower to collect all the credit sales and monitor its inventory so the borrower can settle the debt quickly. If the borrower does not interest or agree any option in the stage 1, we may proceed to the second stage. Stage 2 is known as a collateral liquidation, which means in this stage, there is process of change securities into cash to repay the outstanding principal plus interest due. All the money that has been received after liquidate the borrower's collateral, it will use to settle all the debt with the lender or bank. If there any remaining balance after payment of the debt, the balance will return to the borrower. But if it is insufficient, borrower need to top up the remaining balance of the debt.
Next, we will move to the next stage, which is reducing debt to judgment. Basically, this stage you can take an action on problem loan borrower to pay off the debts. You can bring to the courts for process of court order that confirms the obligation and claims of parties to the loan. Bank must investigate source of income, type of assets available for borrower. At the end, court can decide collection technique of debt. Stage 4 is enforcement and collecting of judgment. This stage shows you 4 methods of collection technique doing by courts. Firstly, levy. Levy is the process bank to take over the borrower assets and then sold at the public auctions, then use the money to settle the debts and other legal claims. The second method is garnishment. Garnishment is third party owing to borrower to repay the debts to the bank. Next method is equity reserveship. Court may appoint reservoir to take control borrower assets and sold at the public auction, then use the cash to settle bank or other creditor. Lastly, method is public sale. Bank can apply public sale to sell the charged asset to the public. And the last stage is bankruptcy. Apply court for bankruptcy to provide for the orderly payment of debts without debilitating a borrower. So when you declare bankruptcy, it signs you are no longer paying your debts as originally agreed, and it can seriously damage your credit history.
I'm going to present about ratio. Okay, there are 4 types of ratio. First is capital adequacy framework, liquidity management, asset quality, and last is performance evaluation. What does it mean by capital adequacy framework? It means capital that provides protection for depositor and creditor in the event of declining value of asset, or in situation the financial statement are suffering unanticipated loss. The amount of capital that financial institution should have is established by the bank management policy and also by the regulator. Okay, there are 2 types of capital adequacy ratio. First is risk-weighted capital ratio and second is core capital ratio. The function of 2 ratio is to measure the bank performance and also to measure the capital that relating to the amount of capital to risk-weighted asset. Okay, next is liquidity management. What is function of liquidity management? The function is to ensure the ability of the institution to compete and remain existent. One of the tasks in the liquidity management is to identify the sources of liquidity. Okay, there are 4 sources of liquidity management. First is new deposit, next is sale of asset, maturity of asset, and borrow fund. Okay, new deposit is sourcing fund from the customer, which is from fixed deposit, investment account, saving and current account. Sales of asset is by selling the financial instrument. Maturity of asset is maturity in the short-term financial instrument. Borrow fund is borrowing from banking or non-banking financial institution. Okay, next is liquidity ratio. Loans to the total asset. The higher the loan to the total asset, the lower the liquidity, the higher the credit risk. Okay, for example, if ratio is 30% of 1 ringgit of total asset, 30 cent is funded by loan. Okay, next is the asset quality. Asset quality is referred to the level of credit risk that associated to a particular asset. For example, an asset that have credit risk is loans and advances. Therefore, it is important for any financial institution that offer loans and advances to have a proper system in controlling and monitoring credit risk. The lower credit risk means it have a better quality of asset and level risk that can be related to the management by financial institution to the market value of its asset and adequacy of the provision against asset losses. Next is majority of bank asset comprised of loan and advances. Bank with good asset quality refer to the loan and advances that do not become bad. Okay, next and last is to performance evaluation. There are 5 credit evaluation process. First is character, which is demonstrate responsibility and integrity of your action. And next is capacity. Capacity is assess borrower debt to income ratio. Next is capital, indicates the borrower level of seriousness. And the fourth is conditions, factor like interest rate, amount of principal. And last is collateral. Collateral is offer the assurance if the borrowers default on the loan, the lender can respond to the collateral.
For this slide, I will explain what is CAMA framework. CAMA framework is the framework systems for banks according to the factors by its acronym that banks have to assign. Okay, what is CAMA? As you can see here, we have C, which is capital adequacy, A for asset equity, M is management, earning capacity for E, and lastly, we have liquidity for L. Capital adequacy is to support the ups and downs of the businesses and to finance fixed assets, also to provide cushions against unexpected losses and to ensure continuing commitment of the shareholders to long-term viability of the financial institutions. Our assets quality is related to the market value of the asset and the adequacy of provisions against asset losses. And the reasons for loan losses is because of the poor credit evaluations, insufficient risk diversifications, connected lending to directors or staff, criminal breach of trust, and loan losses can occur at many stages of the loan cycle. For management should display the highest standards of the integrity, professional competence, and qualities of service, integrity and quality of board of management, level of professionalism, nature and range of services provided, which means that personalities of the banks, their ethical sincerities and behavior while doing the business. All these are to assess the management performance. Next is earning capacity, which does not refer to how much interest income shown in the balance sheets, instead refer to whether the interest can be earned. It takes full recognition of interest in suspense and adequate provision against non-performing loans. Finally, sufficient liquidity to meet customer withdrawals. Source of liquidity can be money at call, investment instruments, and deposit with other financial institutions. Bank policies and uncontrollable factors can influence the income statement. To elaborate this, those factors changes can influence the income statement, which can affect the net income, and through that, ROA and ROE also cause changes. Bank policies is a controllable factor that can control by banks. These are the factors that can affect the income statement. On the left side is the bank policies, and on the right side is the uncontrollable factors. For example, if there are changes in source and uses of the bank's funds, it could influence the gross interest income and expenses of the income statements. Also, for uncontrollable factors, if there are changes in economic conditions and market interest movements. Then, service change, earned and regulations provision can affect the non-interest income. Further interest expenses can be affected by the bank assets and liability compositions. Personnel costs, non-traditional services, marketing costs, cost of office space and equipment. Besides, it can be affected by the inflation. Other than that, compositions of assets, quality of assets, collection departments' capabilities, and other factors such as economic conditions and market interest movements. Taxes in income statement can be affected by tax planning of the banks or capital structure regulations. Lastly, changes in capital structure policies by bank or regulations can affect the financial leverage.
The last one is summary, performance measure. The characteristic that influencing ROA and ROE, also the effect of financial characteristic. So, the characteristic that influencing ROA are net interest margin, net interest revenue, non-interest expenses, and loan losses. For ROE, ROA and leverage measure. The effect of financial characteristic of ROA and ROE are deposit rate decision, loan rate decision, loan losses, and so on. Asset and liability management. Why the company have to manage their asset and liability? Because they have a goal which is to balance its many risk exposure and help achieve its operating objective. So, how to manage liquidity and manage market risk? To manage liquidity, the first thing that the company has to do is to holding easily liquidate asset. The second one is acquire stable liability, and the last one is creating line of credit with other institutions. The last one is to manage market risk. The company have to focusing the interest rate change, because if the interest rate change, it will affect the value of interest-bearing asset and liability. That's all from us. Thank you.